Today, I want to talk about something that's been dominating financial news lately: artificial intelligence, and how it ties into the broader market environment and your long-term financial plan. With AI everywhere in the headlines and the stock market reaching new highs, a lot of investors are asking the same question: are we in another bubble, like the dot-com era? It's a fair question and one to take seriously. There's no doubt that valuations are high and that enormous sums are being poured into AI infrastructure. So today, I want to address those concerns directly. Right now, companies around the world are spending staggering amounts of money, literally trillions of dollars, to build out AI capabilities. They're constructing massive data centers, buying huge volume of chips, and recruiting teams of AI researchers. In some cases, the relationships even look a bit circular. For example, NVIDIA invests heavily in OpenAI, and OpenAI turns around and buys millions of NVIDIA chips. Naturally, people wonder whether this ecosystem can sustain itself if momentum slows. At the same time, this level of investment is contributing meaningfully to economic growth. But the big question remains: is this healthy expansion or the early stages of a bubble? The truth is, it's incredibly hard to tell in real time. The dot-com bubble seems obvious in hindsight. Companies with no revenue were worth billions of dollars. But at the time, many investors believed they were betting on the future. What's important to recognize is that not every surge in spending or market enthusiasm signals a bubble. Look at cloud computing. About a decade ago, there were major concerns that too much was being spent on cloud infrastructure. Today, cloud technology is indispensable to how businesses operate. We also need to consider that today's AI leaders, companies like Microsoft, Google, and Meta, are profitable, established, and extremely well capitalized. That's a major difference from the late 1990s, when many tech companies were little more than ideas. And even in cases where bubbles do form, the underlying technology often still transforms the economy. The internet is the perfect example. The dot-com crash was painful, but the technology behind it reshaped the world. Companies like Amazon lost over 90% of their value, but eventually became some of the most influential businesses of our time. This brings us to an important point. Innovation takes time. Although AI is already showing remarkable capabilities, history tells us that the real productivity gains from new technologies don't emerge overnight. Businesses need time to rethink their processes, adopt the technology, and reorganize around it. We saw this with the railroads, with electrification, and with the electronics boom, and of course, the internet. Each wave brought early excitement, heavy investment, a correction when expectations got ahead of reality, and then decades of lasting transformation. Today's market valuations reflect very high expectations. The S&P 500 is trading near its historical peak in terms of price-to-earnings ratios. That means the market is already pricing in strong growth ahead, growth much of which hinges on AI delivering meaningful long-term returns. So what does this all mean for your financial plan? It means our approach remains the same. We build portfolios that benefit from innovation over the long term, but we also maintain diversification to manage risk and support your other financial needs, whether that's generating income, preserving capital, or preparing for future expenses. While technology may continue to drive markets forward, concentrating too heavily in any one sector exposes you to unnecessary risk. Even the strongest and most promising technologies can experience long periods of underperformance. so your portfolio is intentionally balanced. It participates in opportunities created by AI and other innovations, but it also includes bonds, different sectors, and multiple asset classes that provide stability and income. This approach may not capture every bit of upside during periods of rapid market gains, but it's designed to keep you on track through all types of market environments. The bottom line is this: AI is a genuine technology revolution, one that will likely reshape the economy. But the journey from here to there may be more volatile and take longer than the current excitement suggests. Rather than trying to guess whether we're in a bubble, the smarter path is to focus on maintaining a disciplined, long-term strategy that positions you to benefit from innovation while managing risk responsibly. As always, I'm here to discuss how any of these trends might affect your personal financial situation. Please feel free to reach out with any questions or concerns. I'm here to help.